Hello, and you're welcome to Global Business Insights, where you get more on the main business headlines across the globe. China has fired the starting gun on a 1 trillion renminbi, $140 billion debt sale to boost the economy. The sale is expected to support investment in key areas and reinforce economic momentum in Q2 amid a lingering property crisis. On China, we do get this week earnings from Alibaba and JD.com telling us more on domestic consumption, which is needed to lift economic growth. Earlier today, China's consumer price index climbed 0.3% year on year, beating analyst estimates of a 0.2% rise. CPI inflation came in at 0.1%, that is month on month in April, which was higher than March's 1% decline. But the producer price index fell. PPI fell 2.5% year on year, more than an expected 2.3% drop. Also in China, we saw a contraction in financing activity as credit in April fell for the first time, also as government bond sales slowed and loan expansion was worse than expected, another sign of weak demand. European markets closed higher on Friday as positive momentum continued into the end of the week. And in Europe, France is wooing investors in a major event which starts today, tagged Choose France. Many companies are slated to announce plans to bring their businesses to France. Microsoft Vice Chair and President Brad Smith just said that they would be investing $4.3 billion in France ahead of the business summit. US markets were also attempting a rebound as Q1 earnings looked increasingly mixed. In the US, Senate Majority Leader Chuck Schumer yesterday asked the Federal Trade Commission to halt Chevron's proposed $53 billion acquisition of Hess Corporation, adding that the deal would give oil majors more leverage to raise gas prices. Also in the US, the preliminary May reading for the University of Michigan's US Consumer Index Sentiment Index was 67.4, way below an estimate of 76 and also the lowest reading in 6 months. We got that on Friday. The narrative on rate cuts continue to be the main driver of US markets. Most recent comments from Fed Reserve officials like Bank of Richmond's president, Fed Reserve's Bank of Richmond, President Thomas Barkin reaffirming a patient approach. San Francisco Fed President Mary Daly emphasizing the need for prolonged restrictive policy to achieve the Fed's inflation targets, and Atlanta Fed President Raphael Bostic also hinting at a possible economic deceleration. Despite Powell being more dovish in latest comments, the timeline for rate cuts remains as uncertain as it was at the beginning of the year, with the Fed remaining cautious concerning the initiation of any easing policy. Outcome of April's consumer price index will be key for markets in shaping expectations on cuts. A lot, of course, depends on whether rents and used car prices finally moderate, as has long been expected. In the UK, the Bank of England Governor Andrew Bailey also said they need to wait to be convinced by the data on deciding when and how to ease. However, economists at UBS said they were now expecting the first rate cut from the BOE MPC to take place in June rather than August. On Wednesday, we will get the US April CPI read as well as Nigeria's CPI read. I will preview in this episode what to expect from these reads. And we also expect to get Japan's economy showing a contraction by 1.5% in Q1 as all key drivers of growth slumped due to an uncertain outlook. Data will be released early morning on Thursday. In the US, inflation is likely to come out higher than the Fed expected this week, especially if earlier related forecasts are correct. But the upside is not expected to be material. only material enough to affirm the cautious Fed Reserve approach. On Wednesday, US April Consumer Price Index is likely to have risen 3.4% over the year in April, down from a 3.5% increase in March. Some analysts see more like 3.5% is what we're going to get, still forcing the Federal Reserve to delay cutting its benchmark interest rates, which means higher costs for all kinds of borrowing, such as mortgages and credit cards. To watch are rising gasoline prices in April, which likely fueled inflation to remain stubbornly high. Other data that is suggesting that wholesale prices for used cars, this makes up a significant proportion of overall inflation, fell 2.3% in April for a 14% year-over-year decline. We'll see what the CPI read shows. Something else to watch are shelter costs, which also carries a large weight in the index and is still experiencing faster inflation than other major categories and is slower to cool than has been anticipated by the US Federal Open Market Monetary Policy Committee. If we do see a downside surprise in US CPI, that could motivate the bulls. But the next FOMC is still June 11-12, a lot of time to consider several other data prints, especially the Personal Consumption Expenditure Index that the FOMC tracks to monitor prices. Also, earlier tomorrow, the Bureau of Labor Statistics releases the Producer Price Index for April. The consensus is for a 2.2% increase year over year, 1/10 of a percentage point less than what we saw in March. The recent hikes in the policy rate by the Central Bank of Nigeria continues to calibrate monetary tightening in a data-dependent approach, which is expected to bring the inflation rate down. Inflation leads to depreciation of the local currency, which leads to more inflation. So you can get a spiral that can only be broken by appropriate measures, noting, of course, the adverse impact of excessive tightening on economic growth. In Nigeria, the supply-related factors such as rising cost of inputs also complicate the effort of fighting inflation, requiring collaboration between the monetary and the fiscal side, especially supply-side reform. March inflation was 33% year on year. It was the 15th month of consecutive increases and the highest print in 28 years. The IMF, in their latest Article 4 report on Nigeria, projected consumer price index will average in 2024 at 26.3% and come down to an average of 23% in 2025. Leading analysts, Financial Derivatives Limited in Nigeria, project the April print will increase to 34.25% from 33.2% in March, as among other factors, the return of petrol scarcity pushes up prices, adding that the planting season in March to May tends to depress food supply, also elevating food prices. Food inflation is over half of the basket and is seen as rising to 40.98% compared to an increase of 40.01% in March. Relatively more stable exchange rates will moderate logistics costs, which will alleviate some of the inflationary pressures. At the beginning of the year, Emerging Value Insights projected 23 to 25% inflation by year end. The central bank announced their own target of 21.4% inflation rate for 2024 year end. Of late, we've seen stabilizing in a marked appreciation of the naira, but implementation of public sector minimum wage increases backdated to January and generally higher wage growth across sectors will raise inflation. Costs for producers are already high, and it was a relief when the news came in that the president had instructed the Central Bank of Nigeria to suspend the implementation of a 0.5% cybersecurity levy on electronic transactions following widespread criticism. We could see inflation not as high as analysts are expecting and an abating in month-on-month inflation as tightening has its desired effect. The IMF, however, drew attention to rising food insecurity, which could imply higher food prices, worsened as food is exported across the borders, also motivated by a decline in the naira. High inflation in Nigeria remains the most significant factor holding back economic growth as the government pushes its reform agenda to emerge as a $1 trillion economy by 2030. President Macron of France has announced thousands of new jobs and potential for more in Paris from Wall Street bank Morgan Stanley, German aviation company Lilium, Amazon, and others. Pfizer and AstraZeneca also announced new investments in France worth a total of nearly $1 billion. The French presidency said Amazon would announce an extra €1.2 billion investment, which could create 3,000 new jobs. Microsoft also announced plans to invest $4.3 billion. All this ahead of the annual investment event tagged Choose France, a summit aimed at wooing big overseas businesses and investors. France has lagged major centers like New York, London, and Hong Kong in attracting investment, but Macron hopes to change that. The presidency confirmed today that this year's Choose France event is targeting $16.2 billion worth of foreign investments, up from last year. Investment capitals of the world are doing much more to attract capital inflows beyond portfolio short-term money. South Korea, for example, says it is ready to launch a $7.3 billion support package for chips investment and research as it sets its sights on joining the leaders in the semiconductor industry. The South Korean program offers policy loans and also proposes the building of a mega chip cluster in Yongin, south of its capital, Seoul, which it describes as the world's largest such high-tech complex. EVI has been reiterating that the war for investment and for technology positioning is one that less developed economies cannot disregard as benign to their interests. So there has to be a response beyond appealing not to be left behind, and it has to be preferably a bolder, united continental response driven by the major political and economic institutions. Earlier today, oil prices extended declines amid signs of weak fuel demand, and as comment from U.S. Fed Reserve officials potentially dampened hopes of interest rate cuts, slowing growth and demand for fuels in the U.S. I can see that Brent crude down 0.22%. That's the front month, $82.60 as we speak. On supply, Iraqi Oil Minister Hayyan Abdul Ghani initially said at the weekend that Baghdad had cut production enough and wouldn't agree to do more, but later agreed that any decision was a matter for OPEC and it would stick to whatever the group decided. OPEC Plus would meet on the 1st of June. Asia Pacific markets are somewhat mixed. We can see as we speak that the Nikkei is down 0.24%. These markets are soon to close. Looking at the Hang Seng, up 0.71%. Shanghai Composite, that's the Chinese index, it's been going up and down, now down 0.04%. Shenzhen, China, down 0.59%, while the South Korean Kospi down 0.31%. Asia Pacific markets fell as investors digested China's stronger than expected April inflation data. Chinese equities led losses after the central bank published data indicating weaker than expected credit demand, but losses were trimmed and the Hong Kong's equity benchmark climbed to the highest since August after the news broke of China's $138 billion ultra-long special bond issuance program starting on Friday and eventually including 20-year debt, 30-year notes, and 50-year securities. And it could be a catalyst for the economy and better news for Chinese equities. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share and kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following.